All right, everyone, welcome to class. Please go ahead and take your seats. I am absolutely thrilled to have you all here today. In this explainer, we are going to master the foundational building blocks of accounting. Specifically, we'll be looking at accounts and double entry bookkeeping as governed by Circular 99/2025. Whether your ultimate goal is to become a chief financial officer or you just really want to understand the language of business, what we cover today is your absolute bedrock. So get your notebooks ready, and let's begin this journey right into the mechanics of financial recording.
Here is our roadmap for today. We're going to start by defining the accounting account. Then we'll move into double entry bookkeeping, explore general versus subsidiary ledgers, check our work with a trial balance, navigate the chart of accounts for closing, and finish up with some case studies. Let's start with our very first topic, the accounting account. We'll look at the concept, the structure, and the recording methods.
I want you to read this definition on the screen very carefully. An accounting account is a tool to classify and systematize economic and financial transactions by economic content, to continuously monitor specific accounting objects. Take a second to just absorb that terminology. Think of it as a system designed to bring order to chaos. It lets us track specific items, like our cash or our inventory, continuously over time. Okay, let's make this a bit more visual. Think of your company's accounting system as a giant chest of drawers. Each accounting account works exactly like a separate drawer. You have one drawer exclusively for cash. You have another drawer just for trade receivables, which is the money customers owe you. You have another drawer for merchandise inventory. In real life, you don't mix your socks with your shirts, right? Well, in accounting, you definitely don't mix your cash receipts with your supplier debts. Every single drawer tracks one and only one specific accounting object.
To keep these drawers perfectly organized, every account has to follow 4 very strict characteristics. First, it needs a specific name and code, like account 111 for cash, so anyone can look it up instantly. Second, consistent recording. It only reflects its assigned accounting object. Third is continuity. This is vital class. Accounts are opened and used continuously. The ending balance of this month literally becomes the opening balance of next month. And fourth, uniformity. We don't just make up our own rules here. Everything is regulated uniformly by the Ministry of Finance under Circular 99/2025. Now let's examine the fundamental structure of the T account. You absolutely must memorize this. Assets and expenses behave completely oppositely to liabilities, owner's equity, and revenue. For assets, like your cash, and for expenses, an increase is recorded on the left side, the debit side. A decrease is recorded on the right, the credit side. But for liabilities, equity, and revenue, the whole thing flips. An increase goes on the credit side, and a decrease goes on the debit side. This opposing structure is the brilliant secret to why the whole system balances out in the end. Let's actually walk through the math for Ondoon Company's cash account, which is account 111. Since cash is an asset, its normal balance is a debit. We start with a beginning balance of 50 million dong. During the period, we collected 30 million from sales and 20 million from a customer's debt. We debit these increases. That gives us 50 million in total increases. Then we paid 2 million for supplies, 15 million for wages, and 10 million to a supplier. We credit these decreases, which totals 27 million. So our formula is simple. 50 million beginning balance plus 50 million in increases minus 27 million in decreases. That leaves us with an ending debit balance of 73 million dong. It's just pure logical arithmetic. That brings us to section 2. Double entry bookkeeping, where we'll cover the core principles and how to make journal entries.
This system was actually documented by an Italian mathematician named Luca Pacioli way back in 1494, and it remains the unquestioned foundation of global accounting today. I want you to visualize a balancing scale. The very first principle is that every transaction must be recorded in at least 2 related accounts. Nothing happens in isolation. The second principle, and listen closely because this is an absolute unbreakable law of accounting, total debits always equal total credits. Why? Because every single economic event has 2 sides, a source of funds and a use for those funds. If your scale tips, you've made a mistake. To make sure that scale stays balanced, I want you to apply this standard 4-step process to every single economic transaction you ever record. Step 1, read the transaction and identify the specific accounts involved. Step 2, classify them. Are they assets, liabilities, equity, revenue, or expenses?
Step 3, determine the direction of change. Is the object increasing or decreasing? And Step 4, record the debit and credit. And finally, double check that your total debits equal your total credits. When you're recording these, you'll run into two types of entries. A simple journal entry is super straightforward. One account is debited and one corresponding account is credited. But in the real business world, things get a little more complicated. A compound journal entry involves multiple debits or multiple credits. For example, let's say you buy a computer for 22 million dong, but there's a 10% VAT of 2.2 million. You have to debit the equipment account, debit the VAT account, and then credit cash or accounts payable depending on how you paid. The total debits still perfectly match the total credits. You just have more accounts involved. However, I do need to give you a strong warning right here. While compound entries are totally normal, you should absolutely avoid creating journal entries that have multiple debits and multiple credits all tangled together in one massive complex block. They are incredibly hard to control, they are a nightmare for auditors to read, and they are highly prone to errors. Just break them down into simpler components whenever you can. Remember, control and clarity are your best friends in this profession. Moving on to Section 3, General Accounting and Subsidiary Accounting. Let's look at their relationship and how we reconcile them. The crucial thing here is understanding how these two levels interact. Your general ledger uses level 1, 3-digit accounts, like account 131 for total trade receivables. It's recorded only in currency, showing the massive summarized totals that will eventually appear on the balance sheet. But internal management needs way more detail than that. That is where the subsidiary ledger comes in. It uses level 2 or level 3 accounts, breaking that massive total down by every single specific customer. It might even track physical quantities and specific dates. And the golden rule here? At period end, you absolutely must reconcile them. The total balance of the general account has to perfectly match the sum of all its subsidiary accounts. Now for Section 4, the trial balance. How do we prepare it, and how do we use it to check our figures? Once we've recorded all our journal entries and updated our ledgers, we arrive at the end of the period. But how do we know we didn't make a mathematical mistake along the way? We use our ultimate diagnostic tool, the trial balance. I want you to look closely at the bottom totals row here. The core principle is symmetry. Notice how the total beginning debit balances are $215,000, and they exactly equal the total beginning credit balances. During the period, we recorded $440,000 in total debits, perfectly matching $440,000 in total credits. And finally, our ending debit balances of $533,000 perfectly equal our ending credit balances. If these columns do not match, you stop. You do not proceed. You have to go back, find the error, and fix it. Let's look at Section 5, the chart of accounts, and the period-end closing process. Assuming our trial balance is flawless, we move to the final procedural phase. Circular 99/2025 gives us a uniform numbering system from Type 1 all the way to Type 9. Types 1 and 2 are your assets. Type 3 represents your liabilities, and Type 4 is your equity. Types 5 and 7 are revenue and other income, while Type 6 and 8 track your expenses. And finally, Type 9 is a very special income summary account. Now, here's a quick tip for your exams. Be very mindful of contra accounts. For instance, account 214 for accumulated depreciation is technically an asset account, but it carries a credit balance because its job is to reduce the value of your assets. Now for the grand finale of the accounting cycle, determining our profit or loss. We use account 911, which is a temporary summary account. Step 1, we debit our revenue accounts to zero them out, and we credit account 911. Step 2, we credit our expense accounts to zero them out, and we debit account 911. Step 3, we look at the final balance of 911. If the credit side, meaning the revenues, is higher, we made a profit. So if Anduong Company had 150 million dong in net revenue and 128 million dong in total expenses, account 911 would show a 22 million dong credit balance. We then transfer that hard-earned profit to account 421, retained earnings. All right, class, we are at Section 6. You've absorbed a lot of theory today, so now it's time to test your knowledge with some real-world case studies. Imagine this scenario. You go to the bank, you withdraw 50 million dong in cash, and you bring it back to the office. The correct entry is a debit to cash 111 and a credit to bank 112. But what if the accountant messes up? What if they mistakenly record a debit to bank 112 and a credit to cash 111? They totally swapped the accounts. Will the trial balance catch this error?
The answer is absolutely not. The trial balance only checks if your total debits equal your total credits. It has no idea if you used the right accounts. This is exactly why you have to understand the underlying transaction, not just the math. Let's look at case 2 and see how this builds into profit calculation. Grab your calculators. We have revenue of $200 million plus financial income of $2 million. So that's $202 million in total income. Now let's carefully sum up all our expenses. $130 million for cost of goods sold, plus $20 million for selling expenses, plus $18 million for admin expenses, plus $5 million for financial expense. That equals $173 million in total expenses. So $202 million minus $173 million leaves us with a net profit of $29 million. And because it's a profit, it increases owner's equity, which means we record it on the credit side of account 421.
Case 3 deals with dual balance accounts, like account 131 for trade receivables. Let's say customer Bin Ming owes you $45 million and customer Tuanan owes you $15 million. But you also received a $12 million advance payment from another customer, Dongfeng. Can you just net all these numbers together and report a single $48 million balance on the balance sheet? No, absolutely not. Dual balance accounts must never be offset for financial reporting. The $60 million that is owed to you is an asset. The $12 million you received in advance is a liability. They have to be reported completely separately so you show the true, transparent financial position of the company.
We have covered a tremendous amount of ground today, class, from the very basic definition of an account all the way to the intricate balancing acts of closing entries. I want to leave you with this final provocative thought. The rules we learned today are flawless. Every debit has a credit. Every source has a use. How might you apply these exact same flawless balancing principles to analyze the financial statements of a failing business out in the real world? When the numbers just don't seem to make sense, it is these core basics that will reveal the truth. Keep practicing, review your notes, and I will see you in our next explainer.